Then we took a little bit of a leg up, and now we've been basing on that. And I think that's giving people some, if not confidence, at least better feelings than they had for the last 4 days.
Yeah, I mean, and it's been a Dramamine kind of market, right? I mean, it's been up, down, and all around. So,
yes.
Kerry, Dr. J mentions Tom Lee, and he has some interesting comments out today calling for violent upside in the next 3 months. Retail sentiment so bad, he says, it points to that. In our view, the message from markets is that much of the bad news is priced in. We could see stocks soon stage a sustainable rally. Sentiment is now extremely bearish, and at extremes, that is a contrarian buy signal. What do you make of that? Do you agree with Jim Lebenthal, who said Monday we did put in the bottom?
Well, this is a very important day, technically, Scott, because we have not yet broken the lows of Monday. And if we hold up, and we all know that it's the last 10 minutes of the day, as we've seen this week, that really matters. If we can hold here and not start falling through the afternoon off a cliff, that would mean we've gone through the week, not breaking those lows, coming in on a Friday afternoon with a decent day. And technically, and I know Steve Weiss would say, oh, well, who cares? But I think it matters that if we can hold today and be up, that would be a very good sign going into the weekend. There are 235 stocks now with over $4 billion in market cap that are down 35% or more from their 12-month high. That means that over 120 of them are down 50% or more. If you can't find some bargains to buy on that list, then I think professional investors really are kissing it goodbye, because this is a market that offers you opportunities. They might not be the perfect low, but there are many names that are attractive there, and they're on both the growth side and the value side, I think. So in places, yes, Tom, I really want you to be correct. I would like to see this market go higher. We're not in a recession. I don't think we're going into a recession. There's liquidity, there's demand. I think that the Fed can manage this process. So I would like to believe, and I do think, because we're doing some buying, that it's a spot today where we can make some moves and move forward.
Now, I remember it was Josh Brown who told us to keep our eyes out for closing below the 200-day moving average on the NASDAQ, which we did last Friday, and we know what that ended up portending for the market. So, Josh, take the temperature of the market here, given the kind of week we've had, the damage that we did, the rebound that we had from Monday's low, the volatility that we've all experienced. The Fed has now spoken. We've had a reversal today. You've seen a lot of markets, and I know you read a lot about the markets. What do you think today?
Listen, it's good that I'm kind of like been in a self-imposed quiet period for a little while on social media, because I'm seeing things that disgust me on a daily basis at this point, from like people that purport to be professionals, or people that say outrageous things because they don't actually have any money under management. So there's no client they have to answer to when they make these outrageous statements. And it just seems to be getting worse and worse and worse. And I'm trying to ignore it and not, get into altercations with people. I really am doing my best. I don't know for how much longer I'm going to be able to keep all of this inside. But I'm going to tell you right now, I really don't understand all the hysteria. If you say that you don't like the valuations in some of these growth stocks, and it's this bubble, and it's speculative, and then that bubble deflates, and the S&P is still within 10% of a record high and is weathering these little mini bubbles being popped everywhere, how is that negative? Isn't that what you want? What are you actually complaining about? You don't like the speculation. All the air comes out. These stocks are down 75, 80%. The bubbles are bursting, but the economy is fine. Isn't that a good outcome? Isn't that what you're rooting for? Put that aside. The Kathy Wood stuff is so over the top. I think people have done enough using her name to get clicks. It's gotten personal at this point in a way that it never should. That's a human being. That's a person with feelings. You don't have to agree with her. You could bet against her. You don't have to like her investment philosophy. That's a person. And they did this with Meredith Whitney 7 or 8 years ago. Same exact template. Comes out of obscurity, makes people a ton of money with a call, tries to do something bigger and better, gets media attention, and then they can't wait to rip her guts out. And I'm watching that same thing play out. It makes me sick. I really don't like it. I have no problem with people betting against an investment strategy. That's what we're all here to do, bet on or against. But the personal stuff, it's bad, and it should stop. Last thing, I promise I'm almost done. The buybacks are going to start now. We've had the damage. We've had the technical damage. Not every company is a good company. Not every company has the balance sheet to support its share price. So I don't think you're going to get this rebound where all of these growth stocks that have been annihilated just automatically get to go back to their highs. It ain't going to go that way. I think the quality names, I think the companies that have these fortress balance sheets, and there are very many of them all throughout the index, are probably the best bet. Even if you don't get the biggest bounce out of them, you know that they will have the wherewithal to come in and do some buying. And I think that that's really where the rebound can stick. It's going to be much tougher for that rebound to stick. And I own some of these companies that were SPACs 6 months ago. They have no support. They don't have enough cash to do buybacks. They're too small. I would curb your enthusiasm on the comeback there. It's going to become a little bit more bifurcated, in my opinion, going forward if we have a recovery. I think it's going to be narrower than a lot of people would like. And that's not going to be fun for people that have loaded up on unprofitable companies, but that's just how I see it.
Let me ask you this. You said something, everything you said was interesting, but one thing that jumped out to me immediately was when you said all the air comes out. Those were your words regarding these, bubble things that have popped. In your words, do you really think has all of the air come out of those areas, or does still need to come from them? And that goes to the question that really matters most to people as to whether you think that we did put a bottom in on Monday. I want to know if you think we did. I want you to answer that question, and then whether you think that all of the air has come out of the frothiest areas of the market.
Well, I can't tell you definitively that I think we've seen the bottom, because we really are probably in for another few weeks of inflation data that the market is going to look at that and say, oh, 6th rate hike. Oh, now it's a 7th rate hike. Like, we're still in that phase, which I think ultimately will be wrong. But I can't tell you that the market's not going to have negative reactions to that stuff. But as the question of if all of the air has come out, so I'm not a Robin Hood bull. I've been pretty negative on the stock since it was 70. But I looked at it last night when it was selling off. It was like $10 in the aftermarket. And you look at the market cap is $9 billion. And then you see their press release they put out about their net capital, which I think is like close to $3 billion. So you say to yourself, wait a minute. You're telling me Goldman Sachs could do a Robin Hood buyout for $6 billion? And they're not talking about it? I think there are a lot of situations like that where you don't have to like the company, but you just look at wait a minute, some of these things are a super low risk for an acquisition. We just witnessed a massive deal with Microsoft buying Activision. If you think that's the last one we're going to see in Q1 with the NASDAQ down 19%, I think you'd be wrong there. I think you're going to see a lot more. So there's a certain point where maybe not all the air has come out, Judge, but too much has come out to still want to press those bets. Not in all cases, but I think in some very big, well-known names.
Okay, good to get your thoughts on that. I just wanted to sort of pin you down on exactly where you really think we are, and I think people want to hear that from you. Amy, what do you think? We haven't heard from you in a while, and it's been quite a week.
It has been quite a week. I agree with a lot of what Josh said. I don't know that the bottom is in. I wouldn't make that call right now. I think there's a lot of volatility still to come. I do think the inflation data is going to run hotter, and you're going to get concerns about the Fed. And I think the Fed has a very hard job in front of it, one that it hasn't tried to do in a long time. It has to bring inflation down a little bit, but it doesn't want to cause a recession or financial instability. So I think we are going to be in a choppy market, and I do think that there is some still frothy valuations, but the liquidity is great. As Josh said, there's companies have record levels of cash. Consumers still have record levels of cash. I don't think we're going into a recession. And so I think you have to be very selective here, but there are opportunities to make money from a long-term perspective. The other thing I will add, which I wasn't going to, but I worked with Kathy for over 10 years at AllianceBernstein very closely, and I agree with what Josh is saying. She is a great person, and she works really hard on behalf of her clients. So since some of this is getting personal, and it's not right.
Okay, we appreciate those comments. I mean, look, so much of what we're talking about, at the end of the day, comes down to whether Jay Powell can land the plane softly or not. Of course, the Fed chair. Now that there is this new Fed regime, that the Fed has certainly spoken and spoken loudly this week, and Jay Powell is going to be tested in the weeks ahead. Our senior economics reporter, Steve Leisman, is joining us now. And Steve, that's really what it comes down to, whether Powell can pull this off. And it ain't going to be easy. And I'm curious as to what you think, based on your reporting and those who you talk to, as to whether you think that they can be successful in this.
You know, let me first, before I answer that question, lay out that, having listened to this show the entire week and learned a lot, obviously, there are some bullish members of your committee, Scott, rotating in and out. And I started to think about, well, is there a bullish scenario here for the economy and the Fed? And honestly, I went to go look for it, and I reread Powell's transcript from the press conference the other day. And there is a bullish scenario. There is a soft landing scenario here. And let me walk you through how that would happen. In the first instance, there is no scenario that I can imagine where the Fed doesn't tighten. The Fed almost certainly is going to do multiple rate hikes at the beginning here. And then what Powell is looking for here is supply chain problems and the economic effects of the virus begin to ease. You have a fiscal drag because you're not pumping as much money into the economy. You also have help from a strong dollar. You also have some base effects. All of those things, if they come together, they could, in the second half of the year, work to bring down inflation. The question is not, does the Fed tighten? The question, does the Fed tighten in a way that doesn't cause the job market to slow and the economy to slow? And if all of those things come together, there is that possibility. When I listen to Powell, I'm not sure he's selling that scenario. I think he's very agnostic about it. And what he really keeps saying is, we're going to do what needs to be done to bring inflation down. But that is a scenario that he lays out. It is a scenario that, for your bulls on your committee, if that's what they want to hang a hat on, they can. I just don't think they can do it without at least several Fed tightenings this year.
So a couple things here. I mean, maybe he doesn't want to overpromise and underdeliver, i.e., he knows what happens when he said transitory forever, and then it turns out not transitory, and he has to basically publicly admit that he was wrong. In not so many words, but you know where I'm going on that. So maybe that's a little bit of that. He'd rather err on the side of caution there. JP Morgan now sees 5 rate hikes this year. Bank of America's at 7. Neil Kashkari, Minnesota Fed Pres, with some very interesting statements earlier today, said, quote, "Is it conceivable we could move in the spring and then pause and see how the economy evolves? That's conceivable. I don't want to prejudge it." And then said the Fed needs to tighten, quote, "a little bit." How does that square with everything, Steve?
Neil is among the more dovish members. I think it squares. Guys, I've got another chart on what the Fed approach. I think Powell's going to be steady here. I think he's going to do a couple hikes, and keep. I don't think a 50 is on the table. I don't think Powell means to scare markets here. He's going to put the balance sheet on autopilot, let it run in the background, and he's going to escalate only if inflation does not decline. I think 5 and 7 are ambitious calls for the Federal Reserve. That does not seem to be where my head is at. I'm watching the market, the futures market. They're not priced for that. They're priced for 5 this year. I think 7 is ambitious, and I think that makes sense. I don't really think that. Go ahead.
No. Please finish. I'm sorry, Steve. I thought you were wrapped up. My bad. Go ahead.
No, I think that what the Fed is going to do, at least initially, is what it would do to normalize policy in any event. If you didn't have an inflation problem and you looked at a 3.9% unemployment rate and you looked at a 6% that we just had in the GDP numbers and forecasts for 4% this year, you'd be raising rates anyway. So I don't think initially the Fed is going to do any more than it would normally do to bring the funds rate back into where it is and policy overall. The debate that is on the table is soft landing or hard landing, and I don't know that is baked in. The hard landing is baked in the cake. There is a possibility here for a soft landing with all of those factors coming together to bring down inflation.
We're looking at the yield curve right next to your head as you were speaking. And you have to believe also, Steve, that Powell has got to take some sort of comfort in the fact that he knows his pipes, so to speak, still matter. And they appear to be working and working just fine. The 2 years moved a lot, right? So the market in some respects is doing a lot of the Fed's lifting for it, so that it may not have to do as much as the market fears it might if the market keeps cooperating, so to speak, not from only a rate standpoint, but the equity market pull back too in wiping out some of the most excessive froth pockets in the market. That all plays into part of the strategy of why jawboning is jawboning.
I think that's right, Scott. And I probably have a bunch of screens on my computer here that no other traders would ever have, which is I have a screen here that tells me how much the 2 year has moved since Powell did his big pivot on 11/30. He's gotten 70 basis points of tightening from the 2 year since he made that speech. There was a little bit more before that. He hasn't raised rates at all. So in any event, Powell can take at least some comfort. The transmission mechanism of monetary policy is working. I don't think you could get him to publicly admit that he wants the stock market to decline. But the fact that he's got 70 basis points of tightening, he's got 5 rate hikes priced into the market. He has balance sheet reduction priced into the market, and he lost what he lost in the stock market. I don't think he's upset by that. I can't speak for him. I just don't think he's upset by that.
Yeah, particularly, I can't imagine he's upset with, as I said, the most frothy parts of the market correcting a bit, right? The last thing that he wants to do is inflate an asset bubble any more than critics suggest he already has. But then if you take it in the most speculative parts of the market, that's where you get potentially the most damage if there wasn't any deflation already taking place within those areas. And he's gotten that. And you have to believe that he's okay with that.
And that's why I wish, Scott, just going back that he had withdrawn some of the stimulus earlier and tightened up on the guidance a little bit earlier, not had the market in the fall believing they were going to go into 2022 with a free pass on Fed tightening. I wish that wasn't the case. But that being the case and being where we are now, the extent to which some of that froth comes out of the market gives the Fed more flexibility. It allows them to talk more hawkish now and then withdraw that hawkishness and withdraw that later on if indeed you do get some cooperation from inflation. Look, I know there are people out there that say it's going to be bad and the Fed's going to have to really hit the brakes hard. And when I say hit the brakes hard, that is do more than it would otherwise do just to normalize rates. That's possible. That's on the table. Powell made clear he would do it. But right now, not in the worst position, and now it's up to the numbers and inflation and getting those supply side things clear, getting the virus done, a little help from the dollar, a little help from China reopening up from Omicron. All of that's possible. I didn't want to end this very tumultuous week, Scott, without the idea out there that there is a path here to a soft landing.
Yeah. I mean, look, maybe Kashkari is saying the quiet part out loud in some respects, and maybe Powell hopes that he can get to that point, but it remains to be seen.
Sure,
and the proof's going to be in the pudding. We'll see what happens with inflation and all that. Steve, awesome stuff. Appreciate it as always. That's Steve Leisman, our senior economics reporter. Josh, I mean, look, you've been the one who's suggesting that, the market is going to do some of the Fed's work for it, and that maybe Jay Powell is not going to end up being as aggressive as the worst of the fears are. Let's say if the pendulum is at, 7 hikes is the most extreme point of view as Bank of America puts forth today, then maybe we don't get to near that point if Jay Powell can actually orchestrate this?
You know, one of the things that gets lost when you wake up in the morning at 6 a.m. and you see the futures, you see Dow futures down triple digits, which used to be a big deal. It's less of a big deal these days. But you see a negative 300 Dow, and you're just like, oh, here we go again. It starts to make you forget that we're in a massive expansion right now, and the consumer is spending. And they may be telling the confidence surveys they're not confident, but they don't stop buying dishwashers. And corporate balance sheets have never been in the shape they're in. And profit margins, even with the fact that they, God forbid, have to pay people more money, corporate profit margins are still elevated relative to most of recorded history. You've got so much of a tailwind still coming from the real economy, regardless of what goes on in stocks. So I think it's easy to forget that, but we shouldn't. Because the reason we're talking about tightening and the reason we're curtailing these emergency stimulus measures is because we can and should. And the market is doing some of the Fed's work for it in the form of this kind of multiple compression, mini bubbles bursting, even in crypto, not in NFTs yet. Give that 5 minutes. Like, that's the stuff that should take place. And he doesn't even necessarily have to be involved with it. We'll do it ourselves. And that's the power of that kind of signaling. And I agree with Mr. Leisman. It's nice that that still works. And then you'll get those rate hikes. And one last thing. Go back to 1994. You had this tightening cycle start and spook everybody. You had a huge correction in the S&P after the first 25 basis points, which, by the way, there was no dot plot. It came out of nowhere, right? Spooked the market, spooked treasuries, spooked stocks. The second one, stocks fell again, but not as much. And then they did a 50 basis point rate hike, and stocks rallied. Why did they rally? Because everybody remembered, oh, you know what? Things were actually really good. That's why rates were going up. And don't let me remind you, that tightening cycle started from 6%, not 0%. Yeah. And we all managed to live through the 90s okay.
John Najarian, I mean, you do get a pretty good understanding of the fragility of the market, though, through the way that companies are reporting their earnings and whether they're being rewarded or not, or even if they're being rewarded to a lesser extent than they otherwise might be at a different period of time. That brings me, of course, to Apple, which by all accounts had an incredible earnings report. Jim Suva of Citi was on the network earlier today talking to the gang and was like, wow, I mean, this was an unbelievable report. Katie Huberty out with defense, talking about the clean beat that it was. And yet, Dr. J, Apple's not totally off to the races today. To me, that's a statement of kind of where sentiment is and maybe where we ultimately may be going in the more near term in this market. What do you think? Do you think there's anything to that, Doc?
Well, sure, Scott. The numbers were blowout numbers. Of course, $124 billion record revenue, nearly 800 million subscriptions out there, paid subscribers to Apple products and so forth. The wearables alone, they said, were now a Fortune 100 company. I mean, was there anything not perfect in this report? No, including Tim Cook saying that supply chain issues are being worked out by him working directly with the suppliers. So, yeah, I think if it were not for the overall environment that we've seen this week, we would have seen probably double the move that we're seeing right now. In other words, instead of to 167, I think we would have been up there towards 175. But you got to trade the market you have, not the one you want, Scott. So what I'm doing right now is I've rolled up calls in Apple. I have now pushed out into February and April both my longs and my short calls in Apple. And I think we're going to see a lot more Caterpillars and WDCs where they beat top line, bottom line, but they have to give somewhat weak guidance. And those companies are going to be punished. And those are the ones you want to pick up on dips. I don't think the jumps will be as strong. I think the dips will still be strong. And those are the ones I'm going to try to feast on, Scott. I was trading both those names I just mentioned, Western Digital, Cat, a few others here that I thought dipped a little too much. I think we'll get some opportunities like that. And lastly, I'll just say, when we talk about retail traders, you're really talking about brokers, not retail traders. Brokers that are pulling the trigger because the customers are calling up and they're nervous and they're saying, get me out or buy this, buy that. That's not a retail trader. That is an investor. Retail traders are actually feasting on this. Trust me. I talk to a lot of them. I see a lot of them. Not every trade's a winner, of course, but they are feasting because this is a great setup from both upside and downside, from the very quick movements that you get. This is that trader, not investor time.
I mean, and again, we're looking at Apple here is up $9. It's, better than 5%, obviously, but it wasn't that way early on. It was much less than that.
Yep.
We're getting a little bit of a pickup in the NASDAQ at this moment. So naturally, Apple is picking up. I appreciate that, Doc. Amy Raskin, you trimmed your Apple position that long ago. Are you regretting the fact that you did so?
Well, today I am. What am I? No, we still own it. I think it's a phenomenal company. Obviously, the call last night was amazing and on every level. I just think they got a big benefit from the pandemic. China was really strong for them. China's still in lockdown. They're probably still getting some benefit from that. I think it's a great company. I just don't think it's going to be a great stock for the next decade. We're very long-term investors. Again, we still have a position, but at 2.6 trillion, law of large numbers kicks in. It's not cheap. Basically, it's an iPhone
Amy,
company.
that's never